Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. Last week, India's GDP data gave a pleasant surprise, growing at 8.4% on third quarter, while the entire market was expecting it to grow at 7.5%. So, what next and what else data points are showing for Indian economy? If you see the data points, all data points are clearly indicating that Indian economy is doing well. Indian economy is doing well in manufacturing, surveys, our inflation is coming down, trade deficit is coming down, and current account deficit and fiscal deficit is also coming down. It is a clear-cut indication that all is well in Indian economy. Indian economy data points are reminding me of an Hindi song which says, "Aaj mein aage, zamana hai peeche." Now let us see what is happening in US economy. If you see the data points, it is clearly indicating that most of the data points in US are coming on a negative side. If the data point continues to come on a negative side, it is negative for dollar index and positive for all emerging markets. Now if you see the chart, dollar index, we are expecting that 104.50 is going to act as a strong resistance for dollar index, and gradually dollar index is going to move towards 102 and 100. If that happens, euro and pound are likely to move towards 1.10 and 1.12 for euro. For pound, we have a target close to 1.28 and 1.30. For USD JPY, we are expecting it to move towards 148 and 146. Now let us discuss the outlook for rupee. The rupee is appreciated 7 out of 10 times in the month of March. Apart from that, all economic data points are clearly indicating that Indian economy is doing good. So in the medium term, the view remains the same, that gradually we are going to move towards 82.20 and 82 kind of a level. But in the short term, 82.80 will act as a support for the pair, and the pair might bounce back towards 83 or 83.10 kind of a level. But any upticks should be used by an exporter to increase their hedge ratio. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporters. Most of the thin margin exporters are taking costing close to 82.75 से लेके 82.80. We will suggest them that between 82.90 से लेके 83 के बीच में they should cover 100% on a back-to-back basis. If someone is waiting, then they should keep a strict stop loss of 82.80. Now the question is whether thin margin exporters should overhedge. The answer is yes. कितना करेंगे? They can hedge 5% more of the entire year turnover between 82.90 से लेके 83. I will suggest them they should book long-term forward contract. Say for example January, February, March, where the premiums are on a higher side. Now let us discuss strategy for thick margin exporters like textile exporter or engineering exporters. We will suggest them they should continue cover between 82.95 से लेके 83 के बीच में, and they should keep a hedge ratio of 60 to 65% if they are hedging on an anticipation of entire year turnover. If they are hedging against confirm order, they can take the hedge ratio close to 85 to 90%. Now the question is whether they should pre-utilize their existing profitable contract. The answer is no. Let the profit grow. Now let us discuss strategy for importers. As the overall view of the pair is on the appreciating side, plus March is a seasonality appreciating month, so we will suggest importer then they can cover only 50% of imports which are due for next 15 days between 82.85 से लेके 82.95 के बीच में. With this, I will end my today's presentation. जय हिंद. फिर मिलेंगे next week. नमस्कार.